Thank you, Anil. And thank you everyone for staying for our final panel to discuss private credit and special situation credit investing in APEC, particularly with a focus on India. Our eminent panel this afternoon includes Sandeep Chandak, he's an MD at Vardy Partner. We have Shom Ghosh, the CIO at India's Vivriti Asset Management, Dinesh Goel, a partner at Aris SSG Capital, Claire Roberts, a tech-focused product manager at BlackRock, and Nimrod Way, an MD at Carvel Investors. Before we start, I'm going to give each of them 1 minute to do an elevator pitch about who they are and what they do. Sandeep, let's start with you.
Hey, good day, everyone. I'm a part of Vardy Partners based in Singapore, leading the credit investments in the region with special focus on India. Been a part of the Asia credit for the last 18 years or so, with Deutsche Bank previously, and for the last 6 years with Vardy Partners.
Thank you, Sandeep. Shom?
Thanks very much, Haim. I'm Shomendra Ghosh. My co-founders and I started Vivriti Group in 2017 to create digital infrastructure that would connect investors in several thousands of enterprises on a multi-product debt platform. And we've seen through $10 billion of US dollars of debt volumes to date. Thank you.
Thank you. Dinesh, who are you and what do you do?
Hi, I'm a partner at the Singapore office of Aris SSG with a focus on private investing and special situations / distress investing in Asia, particularly India. I've been with the firm since its inception in 2009 and spent my time in a similar role at Lehman Brothers previously.
Excellent. Claire, what's your pitch?
Thanks. So in short, I build technology solutions for private credit investing. I'm the product manager for the eFront platform at BlackRock, which offers an end-to-end solution for investors, fund managers, and asset services to manage the life cycle of their credit investments, all the way from deal pipeline through investment monitoring, operations, accounting, through to reporting.
Thank you. And Nimrod, what do you do at Carvel?
Thanks, Haim. I run Carvel Investors' Asian corporates business out of Singapore. I've been in the region for 25 years, and about 20 years of that investing in Asian credit and EM more broadly. Carvel is a global asset manager with focus both in Asia, LATAM, North America, and Europe. And that focus includes both liquid, privates, NPLs, hard assets, so forth, so on. Thank you.
Thank you, Nim. So, Dinesh, let's start with you with the first question. Why is private credit growing, particularly in India?
I think, the reason for the growth that we have seen in the recent years is really twofold. One, globally as a class, private credit has been growing tremendously, especially in the US and Europe. And it is logical that those players will now come with that product suite in Asia. The other factor is more local, that we see that particularly to India, banks have a constraint because of several regulations, state-led nature of the industry, still dominated by public sector banks. So there are restrictions on what they can do, cannot do. Also specific to India, the industry has been, the banking industry has been burdened by a very high number of NPLs. And that restricts their ability to lend. You'll see that the banks have gradually been moving towards increasing the pie of retail lending, and that leaves a smaller amount of money for wholesale corporate credit solution. which is really the space that that private lending is coming in. This space, in the earlier part of last decade was taken over by the non-bank sector, which was flourishing in India. But the last 2-3 years have seen that sector also being impacted by liquidity and withdrawing in a very big way. So that is the space that that private credit is coming in to fill in. And yeah.
Thank you. Sandeep, are there specific challenges to getting money into India, to doing deals in India, particularly private credit?
I think there is obviously a challenge given the market structure from an India standpoint and the regulations out there. What I would say is that to invest in India successfully, you've got to be properly set up on the infrastructure side. Whether it's a matter of getting the local entities right, getting the offshore entities which can invest capital in India right. I would think that over our last decade plus kind of an experience in India, investing in India, I think the regulations are becoming more investor friendly, and the regulator has been very very friendly in terms of evolving the regulations where it becomes easier for us to bring the capital into the country. And I think that has been a very positive development course of the last 10 years or so. So yes, there are challenges. You've got to be set up properly to be able to get capital in there, but it's evolving and it's getting better and better.
So what are some of the regulations that have evolved to make it easier to get money in to do this kind of investing?
Yeah, so there's a whole list of that, but I'll highlight a few, right? I think getting the FPIs to the right spot in terms of investing into the country, I think that's a big development. AIF is another one, which makes it easy for the offshore capital to get into the country. And the other one is obviously the whole ARC structure, specifically focusing on the stress and distress side of the story. I think that has enabled offshore investors to access the local market in the right way.
ARC as in asset reconstruction?
The asset reconstruction companies, that's right.
Okay. And to what extent is the opportunity set? I mean, Dinesh, you had mentioned early on that this is private credit is a growing market globally, a growing trend globally. But to what extent is it different in APAC and India versus the rest of the world, versus US versus Europe?
I think there are a few critical differences in the US and Europe. That market has a very high percentage of participation from sponsors. So you have the buyout activity is very active, and those sponsors, when they go for leverage, they prefer private lenders in many instances because of a variety of reasons. Whereas in Asia, we don't see a large part of the corporate world being owned by buyout firms. It's still the landscape is still largely family-owned businesses, and therefore private lending in the APAC context is still very much corporate lending. I also think there's a significant difference in size of transactions because of the place where the industry is in its evolution, and I think that will, as the industry grows, you will see larger and larger transactions that players are able to do when you compare them with the stage of development of US and Europe. And also, while we talk of APAC as one region, really the market, it is a lot of different countries, and the market is very different in each one of them. You take the two largest economies, China and India, and the regulations, ability to take money in and out, creditors' rights are different. So different markets in APAC will evolve differently. I think it has evolved to a good extent in India within the APAC context, but it's still years behind US and Europe.
Thank you. Now, Nimrod, you also, you have a focus on India, but you do Philippines, Australia, other places. How do you balance those different regions, and why is India such an important part of what you're doing?
Yeah, thanks, Chaim. I think that India, relative to some of the other countries, and I think I'll make a comment about China in a second. I mean, I think it's just sheer size, population, geography. So there's just an obvious focus, just given the number of corporates and the variety within the kind of corporate stable. As we've heard, there's startups and tech, and in parallel, you've got the old economy, right? That's trying to navigate the challenges of 21st century, right? So India, just scale is probably the single biggest driver for us. The second one for India relative to other countries in the region was the insolvency reform, right? In 2016-17, the IBC. That was a big catalyst, certainly not just for us, for a lot of funds. And for Carval, it really spoke to our DNA, distressed investing, credit investing. So that was the big impetus. I said I'd make a comment about China. China's obviously the other big behemoth, right? Certainly globally and definitely in the region. And China has its own opportunity set. I think depending on what part of the spectrum, we're particularly active in the NPL space in China, but less active in the single corporate space. And I find that the insolvency, as a practitioner, I think the insolvency laws and navigating the insolvency process in India can be more straightforward. But as I said, that's a really generalization. And then lastly, I would say some of the other countries, be that the Philippines or Indonesia, Thailand, I think that in any given year, there's always a few opportunities in these countries, but I find them to be significantly fewer, if you will, and therefore, given that a private deal, generally your hit rate is lower. It's just a much more complicated, longer process, right, to consummate. So when you think about where you're going to put your resources and your efforts, naturally a larger place with more opportunity like China or India is more compelling, all else being equal.
Okay, so you mentioned the IVC, and certainly it's revolutioned the landscape for India. But over the last, more than a year, since COVID, the central bank, the government has imposed certain restrictions, delays in the way the process operates. How has that impacted the way you're finding deals, doing deals, looking at deals? Nimrod.
Yeah, thanks. At the risk of hogging this panel, I'll just make a couple points. So it's definitely changed deal making from my perspective, both positively and negatively. And I would say, on balance, only time will tell, right? As we kind of get used to a COVID world, COVID-free world, whatever that looks like. Three points I would say: the inability to travel, certainly for me, right? Kind of running a group, the higher cost of doing business, and the unique opportunity set created by COVID. So on the first point, obviously the inability to travel, meet face-to-face with management or advisors, conduct site visits, it introduces challenges for DD, as well as managing existing investments. That said, it is a universal problem, namely executing private deals just takes more time, and naturally fewer players are willing to go the distance, thereby reducing competition. Number two, I think to compensate for and mitigate the challenges of travel restrictions, we Carval at least spent a lot more on advisory mandates through retainers, exclusive arrangements. We spent a lot more on background and investigation services. We also supplement all of our onshore legal with offshore legal. So negatively, this increases the cost burden. We also have more broken deal expenses. In my experience, my entire career, I would say there've been more kind of broken deals in the last year and a half than in the 20 years prior. But positively, I would say the relationships we're forming, surprisingly, even though they're often Zoom-based relationships, we're getting deeper because we understand we rely on certain experts, be that industry, be that functional experts, turnaround managers, whatever you have, and they're becoming much deeper, and we're spending a lot more time, and those are invaluable relationships and really do differentiate one firm from another, and your successes and failures going forward, because we all run into, best laid plans tend to go awry. And when they do, you need friends. And then one last thing on the opportunity set, I would say that COVID's created sectors. So transportation, hospitality, obviously COVID and the lack of visibility on recovery has created opportunities. And although COVID, has become a cottage industry rife with error, right? Trying to predict when it's going to end. I think the art of pricing risk in this uncertainty separates the wheat from the chaff, right? Conservative from cavalier, right? Good from bad. But again, in summary, I think only time will tell, right? On in the post-mortem.
All right. Hopefully we get there soon enough. Shom, how has COVID impacted what you're looking at, what you're doing?
No, so for us, I think I'm just going to add one quick point to why this is on a rise, private credit. And this is a structural point beyond the fact that there are some extant players who are stepping back, which Dinesh talked about in India. I think there's a demand side trend as well. So learning from the pitfalls of disproportionate reliance on bank loan markets, business owners and entrepreneurs are consciously looking to diversify sources of borrowing. This point is important because India has very, very shallow debt markets. And that's why there is very high potential for private lenders to step in. Right. So that's a more structural point. As far as we are concerned, Chaim, allow me to take a minute to tell you a little more about how we see this space. And to do that, we should not count the companies that we know in India, right? We should take a top-down approach to what's out there. We're a country of, believe it or not, 22,000 firms that carry investment grade rating by an affiliate of a Fitch, a Moody's, or an S&P, right? With very few of these, and I'm talking not more than 20 companies of this controlling 40% of the roughly $500 billion corporate bond market in India, which includes a very long list of deserving but undiscovered companies. Now, these aren't in stress. These have not been disproportionately affected by COVID. They aren't early stages either. They aren't even unproven business models. They're simply lower on scale, right? So they're below the AA curve. And sectors here are defensive. Some are healthcare, products, services. There are consumption-related sectors like staples. There are sunrise sectors which are directionally correct: clean energy, technology, agriculture, retail, financial services. So from our standpoint, investing in these is what we call the performing credits space, where volatility of outcome continues to be low, even after we've seen through the last 15 months, which is, I think, extraordinary in most of our careers. And the money is supporting growth. And in many cases, these are companies steering the Indian economy out of the pandemic. So that's how we see it, Chaim.
And how are you keeping track of these companies? These are the smaller ones. They're off the radar. How are you finding them?
Thanks for that, Chaim. In fact, I think the way we see it, and this was the thesis with which we set up the Vivriti group, we think technology has a very, very fundamental role in executing this right. And we are redrawing enterprise finance with the use of technology. And to our mind, this is not just linked to one thing or the other. It's the common backbone for deal making, portfolio management, reporting. Because you see, to be able to access and make sense of very large data sets, we have to use information objectively and manage risk on ongoing basis. That's a key one. Now, why that's important in India? In the last half a decade or a little more, you would have seen heightened levels of data democratization, digitization of several public records, right? Immense digital footprint that companies are leaving behind. So if you don't consider all of that into your diligence, then we're missing out on something. So which is why deep use of technology and data is one of the key pillars for us to be able to manage risk right in a segment like this.
Got it. Now, clear, that's right up your alley. Well, private credit in many ways is as old as the village market. Many people still are using spreadsheets to keep track of what positions they have and when payments are supposed to be made. What can they be doing to improve that?
Absolutely. Thanks, Haim. So I'm coming at this from a slightly different angle in that, as I said at the beginning, I build private credit solutions for the different market players here. And that really means that I speak every day to a variety of different clients across the world about exactly that question. What can technology do to help ease the pain points that those market participants have? And one thing that I hear really commonly is that when people hear tech, they expect we're going to talk about artificial intelligence or blockchain or something in that sphere. And that sometimes puts them off because they think of those things as sort of nice to haves. And the truth is that the biggest impact that technology is having on private credit investing today is answering much more fundamental questions. And really, I think of this as two questions. The first, how can you get better data, get better insights from that data, and therefore make better decisions? And then two, how can you free up members of your team to work on more value add activities? Or put another way, scale and information transparency. And that's really that's it. That's as complicated as it gets. But of course, in this space specifically, we've already heard from Dinesh. It's not really one space or one asset class. It's this highly diversified, fragmented space, and even more so in Asia than in the rest of the world. So we have to be really careful that any technology solutions that we implement are smart enough to avoid manual workarounds and to capture that nuance, because the technology should really be enabling and not inhibiting your workflows. So really, I think of that in three different ways with the eFront tools that I manage, and that's just data, analytics, and operations. So in the data space, how do we streamline the collection of data, eliminate any manual copying and pasting, and store everything in a single place so that we have a single source of truth, full transparency, and everybody in the organization can access it. And that might sound really obvious, but this week I got an email from a client saying, I've waited 15 years for this data to be in one place. And that is a US firm that is not unsophisticated, and they're definitely not alone. Access to data, and in fact, internal access to data that the firm has, it is a pain point that I hear really regularly from clients. So I think that the kind of fundamental pillar here is how do we get data into the business in a streamlined way and give everybody access to it. And once we've got that data at our fingertips, the analytics on top of that makes getting value from it much, much easier. So whether you're looking to benchmark a potential investment against peers, run more sophisticated risk modeling, or simply forecast performance, the sky's the limit there, really, if you've got your data in a good place and you have the right tools to run those analytics. And then the final thing that I would say here is automation of workflows. So at every stage of the life cycle, to your point in the question, we find clients using Excel sheets and a number of sort of manual workarounds that are really human intensive. They need more people to scale. And simply automating some of those processes can free up a huge amount of time. So ultimately for me, the question of technology is just about finding the areas which really add value to your business through either time saved or insight, and focusing in there. And the final point I would make is that as interest in private debt continues to grow, technology is likely to be a key differentiator in who can scale effectively. So I think that we're entering a really exciting time actually for private credit technology, and very much looking forward to seeing how this evolves over the coming few years.
Is there something about private credit that requires specific kind of technology or platforms?
Yeah, so It's a few different things. First of all, it's a really operationally intensive asset class. We need a lot of data to effectively manage private credit throughout that life cycle, and we need that data really, really regularly. So something I hear from clients all the time in the private credit space is that processes that, if we're looking, for example, at private equity, might be acceptable, a sort of manual workaround to pull that data in. In the credit space, where we need that data on a really regular basis, it becomes too costly to think about those manual workarounds, and the automation really provides an unlock in terms of scale. So a part of it is just the nature of the asset class, the information it needs to be managed effectively, and just the fundamentals. The other piece to the private credit technology is this nuance. So I mentioned, and as did Dinesh, how fragmented this space is. Actually, we say private credit, but that can mean 100 different things. It's a lot. It hides a lot of complexity in terms of the sub asset classes here. And then we layer on complexity in terms of strategies, in terms of geographies, including all the regulatory requirements. And we really need to make sure that we have a solution that is able to cope with all of that nuance, because it is key to the asset class in a way that can't be ignored. So it doesn't make sense to implement technology solutions that insist you force things into a one-size-fits-all mold. You really need a solution that works with all of that nuance.
I can see a lot of nodding heads here. Sandeep, how do you guys use technology to help you guys out?
Yeah, I was listening to Claire, and I'm glad that Vade is not the firm which would have called Claire. We are pretty well integrated from a technology standpoint, special focus on technology, and where, one of the things which Claire mentioned, we do have an access to an app on my mobile phone, which basically has, all the positions Vade has globally, which I can access on a real-time basis in terms of performance and positions. And that's a very, very powerful tool for all of us, right? And another part of that is how we operate as a firm. From a Vade standpoint, we are looking at, a world which is, fragmented, moving in different directions, and industries which are somehow correlated. And having the right kind of access to technology and right kind of, access to the database, which one of my colleagues is looking in New York or in London, is very important for us to make real-time investment decisions as well. So, from our standpoint, people and technology, both of them are very important tools and part of the investing world. And I don't think anyone from an investing standpoint can go away from that fact, right? I think it's a very important tool and very powerful tool internally for us.
Thank you. And Shom, I know it's key to what you're doing. Is it possible to even do the size of deals you're doing without technology?
No, it's not. And we start with it, we play with it across the cycle. Let me flesh it out with one example of what we do with tech. Let's take an example. A healthcare firm or a financial services firm wants to borrow from our platform for growth, either from our own funds or from investors out there. They sign up on our digital debt platform. They undergo several rule engine checks, validating them on their revenue, working capital position, expenses, and whatnot, up to legal cases, because these records are digitized. These public records are digitized, and one can mark them up. With all of this information, there's a digital profile created. It's benchmarked to firms of the same kind, nature, and size, so that when an investor looks at something like this, she or he is starting the diligence far more informed and ready. This is point number one. This is on sourcing and assessment itself. Point number two, on structuring an investment today. To give you an example, if I take a complex transaction like a securitization backed by retail loans, everything from asset pool selection to loss estimation, rating estimation, and several iterations to arrive at the right risk-adjusted return. This can't be done without technology. Thirdly, post-transaction risk management, which is extremely important when you're talking of maintaining granular portfolios with small companies. The firm reporting to the investor on the performance of its own performance and the asset performance for which we've lent, and ongoing sectoral benchmark. All of this is, it's technology is needed to be able to manage granularity at scale. So which is why we think it's imperative.
Thank you. Dinesh, to take it to the other side. So Shom is dealing with the smaller companies. You guys have become over the decade quite a large fund. You need some scale. You mentioned before how in the US and Europe, a lot of the deals are sponsor driven. You don't have that in APAC, particularly in India. So where are you finding scale and opportunities to move the needle for your fund?
Thanks, Haim. See, the opportunity set in Asia, as on date, largely is corporate, family-owned businesses, and finding solutions from them that they can't find from their traditional providers of capital, the banks and even the equity market. And I think going back to your earlier question on how COVID and technology has impacted this space that we are fairly active in, it has had similar challenges that Nimrod articulated earlier. But as a firm, we have a philosophy of being very local. In all the key geographies of Asia Pacific, we have local offices. We have people on ground who are helping us run the investment sourcing, analysis, and post-deal monitoring as well. And I think that has been a real differentiator for us during this entire COVID period. For us, the last 15 months have been a period of not only record investing in Asia Pac, but also record resolutions and being able to distribute that money to our investors. So I think that is a key differentiator, being local. It was not planned that way, but COVID ended up making that as a unique advantage to our franchise. And I think it has its own advantages anyway. Being connected, having the local intel, able to do diligence. I'm keeping my fingers crossed. Things have opened up again. My colleagues in Mumbai are now able to travel and do the diligence and meetings the old way, which is a welcome change, and we certainly hope it continues.
Yeah, if I can add to that, right? I think I concur with Dinesh in terms of the whole way of doing business in Asia, and I think another leg of that is building the relationships, right? I think over the years, it's required to build those kind of long-term relationships, with the counterparties, with the sponsors, with the even for that matter, the advisors, intermediaries, everyone in the business, and that has been one of the focus areas for our firm as well, right? And that's the reason when, even when the pandemic hit this part of the world, we were still able to deploy decent sized capital, over a couple of $1 billion over the last 2 years in the region. And that gets possible only when, you have the right kind of relationship built in. It's important not to have fly in, fly out kind of a mindset for this region. And that's true for the entire region, not just in India, but, for Australia, for that matter, Indonesia. And you have to have the local relationships, local offices. And Dinesh is right, having a local presence for us also kind of makes all the difference when you can see continuity, when you can meet people. And yes, people can be on Zoom, but, having a face-to-face meeting makes a lot of difference.
So, Nimrod, to move off of India a little bit, I've covered a number of your deals that you've done in India and in Indonesia and in Australia, but Indonesia and Australia have come down a little bit. Indonesia particularly used to be a decade ago or 2 decades ago when the private credit market in Asia was starting, it was one of the key markets. What's happened there now? Why aren't we seeing a lot of activity? Why is that one kind of gotten quieter, let's say?
Yeah, It's a good question because if you look at actual funds flow, right, there's actually been quite a bit of investment in Indonesia, certainly over the last few years. But a lot of it is actually gone into more private equity, more growth equity, a lot of tech, just the sheer size of tech deals, right, in Indonesia. From a credit perspective, there's definitely been a private credit market, but what I think a lot of private credit has manifested in somewhere in Indonesia, and I think it's somewhat in contrast to India, is that when things go wrong in private credit in Indonesia, they generally don't get resolved very amicably, right? The notion of creditor classes, secured and unsecured, right, ends up becoming an illusion a little bit. I think it really boils down to relationships, right? Sponsor families, dealing with the right sponsors. But even that can be a misnomer, right? You go in thinking it's the right sponsor. By the time you leave, it might not be the right sponsor. So, and there's all kinds of other mitigating circumstances as well, right? An economy, a business cycle hits, and what might be well-intentioned is less so because of unforeseen circumstances. So what I would say is Indonesia, in my frank opinion, has to get their act together, right? And this is kind of a general statement. I think, for every positive story on technology, and Indonesia's got a lot of that, right? They've really gone forward on technology, on telecoms, wireless, but then they're living in the dark ages when it comes to simple, basic notions of creditor rights, insolvency, courts, right, and workouts. I mean, we buy a lot of portfolios. We bought multiple portfolios of NPLs in Indonesia. Some have worked out great, and some have not. And the ones that have worked out really well are very, very specific. They're very small. They're very retail-oriented micro loans, whereas the kind of middle, larger SME stuff where borrowers can be litigious, you'll get dragged for a long time unless you have a consensual workout. So I'm going down a rabbit hole. Let me step back to make a point. Indonesia really needs to get its act together. That's my strong view. I think the reforms for the insolvency regime, for workouts, are critically lacking, in sharp contrast to India, right? India is still, I'm looking for the right metaphor, but it's not easy. But at least India is making noticeable strides. 2 steps forward, 1 step back. Litigation sucks in India. But nevertheless, there is a concerted effort by the administration and the entire supporting cast of characters, from advisors, right, to banks, to investors. Everybody wants it to reform. Whereas I'm not convinced the same holds true in Indonesia, and therefore private credit pales by comparison in terms of just quantum to a place like India.
One of the areas I remember writing a lot about Indonesian private financing was coal mining, and now somehow that's become to some extent verboten for investors. We're all in an ESG world. So, Dinesh, to what extent is ESG a morality branding story, and to what extent is it a fiduciary investment story?
I think certainly for our firm, ESG has become very front and central to our investment decisions. I think maybe 8-10 years back, it was still there somewhere in an investment memo, like a check the box that you've got to look at everything. But today it is a very different story. It is, like I said, front and center. People need to really look and analyze the ESG impact of any investments that we are looking. There is a healthy debate on ESG issues when you are discussing any investment proposal in the investment committee. I mean, we've even instituted to make sure this change is actually inculcated by the investing team and the entire firm. We have had experts coming out and explaining to all the members of our firm how to look at ESG, what are the various parameters, because I'm not sure, like we have not grown in an environment from the early part of our careers where ESG was part of our grain. But there is a very, very strong concerted effort from our investors, from our management to make it front and center. And I think that is the way it will be as this industry evolves. We have shot down investment proposals where they made a lot of commercial sense but did not meet the ESG criteria for the firm. And that is here to stay. And I think, everyone has adopted. In our opinion, when we talk to our investee companies, they also understand and they are making the changes in the way they run their businesses. So I think it is as critical. It is not embedded somewhere in page number 55 of your investment memo. It is page number 1 to 5.
So for example, where have you seen a company that has, because of the global effort, the global focus on ESG, for example, is there a company that you've worked with and you've seen something specific come out, some evolution, some change in how they're doing stuff?
No, we have invested in companies and we continuously review them from an ESG perspective, and we have made recommendations based on our own assessment, engagement of our experts on how they should implement some of the governance parameters or how they can make a better impact. See, there is a limitation when it comes to private debt investors because they don't have as much of a say after an investment is done. So the biggest part of our consideration is, are we lending to a corporate who is a good ESG player? Vis-a-vis a private equity where a lot of it happens also afterwards because of the nature of their investment and the rights that they have and the participation they have in the company. So for us, it is more a criteria whether this is someone we can partner with or we can lend to.
Got it. Clear. Are you seeing this move as well from your side, from dealing with investors?
Yes, absolutely. So the story that Dinesh just told is one that we hear really commonly. ESG is clearly, I would say, the hot topic at the moment. And this theme of really needing to make that central to the investment process is something that is really coming up everywhere. And what we hear about this is that the main challenge is data, because with the best intentions, it's only meaningful if we can actually measure it in a reliable way. And I think that's really where the technology piece comes in here, where that's going to be incredibly important. Typically, we see two approaches. The first is self-reporting, and then the second is the outside-in approach, so using data from other sources to score ESG performance. And typically, the most successful strategies use a combination of those two to get the best data. So from a self-reported side, it's easy for it to become, like any data collection exercise, really burdensome to have to go out and collect that data from borrowers or other players. And that's where we offer a portfolio monitoring solution to specifically manage that challenge of collecting data in an easy, standardized way, again, to the point earlier, that is then immediately integrated into that single source of truth and available for people to analyze and to feed into the decision-making process. Where we then increasingly see that partnered with the outside-in approach is then to use other tools to pull that together. And in particular, one area where there's been a huge amount of growth is LPs who want full transparency on the ESG credentials, not just of the manager, but actually of the underlying portfolio. So I would echo the sentiment that this is here to stay, and it's something that we're going to see a lot in the coming months and years.
Sounds like it's coming up and down companies all the way to LPs, etc. All right, we're coming to an end. Thank you all. Thank you, Sandeep and Shom and Dinesh and Claire and Nimrod, for your insights and for informing us about India, ESG, technology, the rest of private credit in Asia. Thank you, the audience, for sticking around for this last panel. Hope you all learned a lot. Have a good day. Anil?